Everything in your trading journey does not matter at all if you don't know how to read technical analysis correctly. If you don't, you will never make money in your trading career at all. I know you've heard of all these different ways of trading, news trading, bots, indicators. These ways, they are too unpredictable. Technical analysis is the most predictable way to trade, simply because you wait for patterns that repeat themselves every single day, and they will continue repeating themselves forever so long as candles continue printing. If you don't know technical analysis, or you want some clarity on things like market structure and other things, then this video is all about that. And make sure you watch till the end, because I am going to give you a full guide of how I've been using technical analysis in the last 5 years. First things first, with technical analysis, you need to understand the charts and the tools and trading platforms that you require to get started. Let's go to the charts. Step number 1 is go to tradingview.com. Tradingview.com is the site that will allow you to view the charts. Now, if you are a complete beginner, these charts look all confusing, just things going up and down, up and down. I want us to break down exactly what we are looking at so that you can have some clarity. Step 1 is understand your platform. This is the tool that you are using. Up here, where it's written US 100, this is your search bar, and you can search any pair that you want to trade. For me, I trade the US 100 or gold. So if you search here gold, you can see here gold. I go and pick the gold that I want. Once you have your pair, then next here is what we call time frame. There are so many time frames, from 1 ticks. There is also seconds. There is also minutes, hours, days, weeks, years. A candle is just a representation of price and time. So for me, I prefer using the 3-minute time frame, and this is the only time frame that I use. So this is what we will use in this video. From there, now we can look at the charts. Up here to your right, we have the watch list. You can see this is where I have US 100 or gold. If I want to trade whichever, I just come and click it. Now, let's go and look at the charts themselves. These charts are made up of candles. And a candle is just a representation of price and time. You can see we have green candles and red candles to differentiate the direction of the market. For me, if I see a green candle, it means price is going up and we are bullish. And if it's the complete opposite, say it's going down and the color is red, then I know we are bearish. And it's these colors that tell me all the information I need to know of where price wants to go. If it's green, we are going up. If it's red, we are going down. Let's break down the structure of a candlestick, because this is the basic foundation of technical analysis. A candle has 4 parts, and 2 of these parts, they remain the same. This is called the high, and the high remains the high whether the candle is bullish or bearish. Think of it as a head. So whether you are a woman or a man, a head is a head. It's up here. And the legs are down here. They are called the lows. So the low and the high never change. Another thing is these lines. These lines are called wicks or tails. They show where price has been. Think of it like a trail. So if price was up here and then it went down, this line shows us that price was here at some point. So the wicks are just giving you information. They give you the high, they give you the low. If the candle does not have a wick, then this is the lowest point. The candle again has what we call the open and the close. Actually, the close is what determines the direction of or the color of a candle. If you think about it, if we are going up, the candle opens down and then goes up. It closes up. If the candle is going up, the close is always above the open. And if the candle is going down, the opposite is true. The open is up and then price goes down and it closes down. That is how the candles are actually made. The close determines the direction of the candle. These are now the cells, because think of it, when I say cells, I mean think of cells in your body. Let's go back here and look at now the candles. Each candle in itself is giving you information about what is likely to happen to the next candle. And the next candle is giving you information of what is likely to happen to the other candle. And that is how you can follow each candle one at a time. And that technical analysis is the one that guides you to know, oh, it's time to buy, it's time to sell, it's time to put off risk. Now you know candles. The next thing after candles is what we call support and resistance. Markets will only do three things. Markets will either trend upwards, markets will trend downwards, or the markets will consolidate, which means just moving sideways. What is support and resistance? So when the market is moving sideways, it reaches a certain point where it cannot go further than that, either to the upside or to the downside. If price tries to go past, say, $10 and it's not passing $10, every time it reaches $10, it starts to reverse. Every time it reaches $10, it reverses. You have a ceiling of price. That is what we call resistance. And to the downside, say it goes to $7, then goes to $10, and it's ranging between that. Then that $7 becomes your support. And support and resistance happens when there are many candles like this. For example, if we look at all these candles, we notice that here, price tries to go down here, fails, tries to go down again, fails, and then continues in that line, fails, it reaches that point, it fails. So we can see there are multiple times when price tried to pass a certain line. Another example can be here. Notice, price went up, price went down, price went up, price went down, price went up again, price went down. This is support, this is support. And even to the upside, you can see price tries to go up, fails, goes up, fails, goes up, fails. That's resistance. So what's the significance of support and resistance? If we come back to our candles now, the high is your area of resistance and your low is your area of support. Why is this important? So this is important because this is the easiest way to draw your support and resistance. If you don't know what to draw or where to draw your lines, just look at the most recent candle. Draw the high and the low. Most recent candle is this. So this candle, if we look to this area here. So if we look here, you can see here we have 49, 48, 47, 46. This candle has about 45 seconds left before it closes. So as it's doing that, all you do is just draw its high and low. And then if it continues pushing the high before it closes, continue going with the high like that. Once it closes, now you have your clear, most recent area of support and resistance. Why is this important? This is important because we said the markets can only go up, go down, or consolidate. So how does that look like using one candle at a time. If this is your candle that is your support and resistance, then the color of the candle tells you where price wants to go. So if the color is red, then we know price wants to go down. And we want the next candle to do what? To continue going in that direction. This is what brings us to the next term, which is called breakout. So when you draw your support and resistance, when price breaks to the upside, it means we want to trend to the upside. And when I say breakout, I mean the next candle goes above that line and stays up there. Breakout to the downside means we want to go down. And if we just stay inside, it means we have consolidated. We have not gone anywhere. So that is price ranging. So you can see the movement of trending upwards, trending downwards, and just consolidating using one candle at a time. In our case here, we had our high, we had our low. Now, the candle itself is telling us the color is red, which means price wants to continue going down. So if this next candle closes to the downside like that, then you have confirmed that the sellers are in the market. And that is where you take your sell position. You put your stop loss above breakout candle and you are targeting a 1:2. The next thing is trading at the right time, because if you look at this movement, you want to trade here. You don't want to trade here. You want when there is candles that move like this, you want to avoid this. This means that you need to come to the market when the market is opening. So in any given session, you come to the market at the market open. This is when you'll have these moves most likely. For example, right now, London is about to open. The market, this is 254. So if we close to the downside and the market continues breaking to the downside, there is a very high likelihood that price will continue going down. Come to the market at 3 a.m. New York time for London. So this is 3 a.m. for London. 9:30 a.m. for New York, and then 8 p.m. Actually, it's 9 p.m. and then 9 p.m. for Asia. Like for example, this candle has closed to the downside. This is a breakout candle. I am going to take a short position here. I'll put my stop loss above this high. Since the market opens, there is some volatility that might come to the market, and this candle does not have a wick, so we might see some price coming to the high, but we are saying we are going down, and then we are targeting this low here. Simple as that. And then we wait. So basically, that is how I use technical analysis every single day at the market open. Subscribe if you got value from this video.